All right, it's 7:03 p.m. Let's get started. First of all, today we are very privileged to have Eugene from Nico AM. Maybe you can say hi. I'll do an official introduction later.
Hi, everyone. Thanks for having me.
Mm. So without further ado, let's run through the agenda for today. I think for some of you who have registered through the link, you'll see that Kelly was supposed to be the host, my colleague. Unfortunately, due to some unforeseen circumstances, she's unable to make it today. So she's similar to our title, down today, but definitely not out. So she'll be back soon and join us for our webinar in the future. So I'm your host today. Again, I'm Jared from the digital sales team in Saxo. And let's get started. A little disclaimer before we proceed further. This presentation, this webinar today is brought to you by Saxo Capital Markets as well as Nicole AM for your general knowledge information and does not take into account for any personal financial or investment advice. So for any investments, please do your own due diligence accordingly. This would be the agenda for today. While waiting for some of our guests to arrive into the webinar, we'll run through a little bit on the Saxo Trader Go, as well as some of these new platform updates that we have. From the next 25 to 30 minutes, that's where Eugene will run through REITs, this today's topic, down but not out. Again, Eugene is a ETF Business Development Director from Nico AM Asia. And after this presentation, we'll have a approximate 10 minutes for Q&A session. So do feel free to drop in your questions. It should be somewhere along the sides of your screen, or if it's on your mobile, it will be somewhere on the bottom, I believe, to drop in any of the questions related to today's topic. And we'll end it off with some closing remarks. And let's get started. So you can simply Google Saxo. It will bring you to our official webpage. Over here, you can find a wide range of information available, such as the products that we can trade in. So for the benefits of new users, you can look at this wide range of products and instruments, asset classes that we provide in Saxo. Of course, we strive to be a one-stop financial solutions provider. So do take a look, and I'll bring you through the different platforms that we have. So we do have three different platforms available for clients to choose from. Again, they can be used interchangeably. So with one login ID and password, you can access to all three of our platforms. So the simplified version, trading in cash products such as ETFs, bonds, and stocks, you can look at Saxo Investor, a much more intuitive platform for simple investments or long-term investments. Whereas Saxo Trader Go would be our award-winning trading platform, trading across a wide range of products from stocks, ETFs, funds, to options, CFDs, FX, futures, and etc. And last but not least, we have Saxo Trader Pro, which is our professional grade platform. Can support up to 6 screens at once for your trading needs. So for the benefit of today's demonstration, we'll go ahead with Saxo Trader Go. So upon login, this would be the interface that you'll be looking at. We have three main headers: trading, research, and portfolio. But today, let's take a closer look at how you can navigate our trading header. So we have three different modules, or I would say windows over here, on the left, on the right, and at the bottom. So how do you search for an instrument? It's very straightforward. You can either type it through into our main search instrument search bar. For example, Tesla. You can look at the different instrument class available for you to trade in with Tesla, such as CFDs, equities, options. Simply click into it, you'll be able to identify the product overview and additional information. So what I would recommend for you to do for anyone is to use the screener function. This is a place where you can filter out some of the important criteria when it comes to investing for you. And from here, you can filter down to what is important, and it's a tool for you to really streamline and look for investments that are catered or suitable for you. So for today, perhaps let's try to look for ETFs. And these are the different criteria you can look at. Issuers, for example, our host today, Nicole AM. So these are example of the ETFs provided by Nicole AM. And once you have identified which are the ones, which ETF you'd like to invest in, you can simply click into that ETF, click onto the trade button, and from here you can place your order. Different order types such as limits, market order, the volume you would like to purchase. Once that is done, you can look at the cost as well as trading conditions. And once you are satisfied, you can place your order from here. So funding the account right now, it's a much simpler process. On the bottom of the screen, there's this blue icon. That's where you can do a direct debit authorization, linking a bank account, which is a new feature that we have for easier inwards and outward of funds whenever you wish to do a fund transfer. You can also really look into our research page for hot topics, as well as zooming into various asset classes for trade inspirations. I think I have taken up about 5 minutes. So I will pass the ball to Eugene for his presentation, and I'll catch you again.
All right, thank you, Jared. All right, thank you, everyone, for joining us this evening. I know your time, especially evenings, is precious. So thank you, Saxo. I was just looking at the screens. I think it's a very professional screen. I just a bit more about myself before we start. Just a quick introduction. I started my career really with Thomson Reuters back 10, 15 years ago. And I have to say the Saxo screen is really institutional grade. It's something that you should really explore. And then I moved on to be a bond trader for about, that took about 5 years of my life before moving on to SGX, where I got into a bit more focus on bonds trading, the bond trading platform, as well, the ETF business that we're trying to build at SGX. And that led me to Nicole AM, who is, in terms of ETF issuance, we are the issuer with the most number of ETFs listed on the Singapore Exchange. We've got 6. Of interest today would be the Asia Japan REITs ETF. So it is the largest Asia Japan REIT ETF in Asia. And I think that really segues into what we want to speak to you today, right? We know it's been a tough year, right? Inflation concerns started really early this year, exacerbated by the Russian-Ukraine crisis. We all know about that. That really led to the central banks, just figuring out how are they going to put a curb on inflation. What are the tools available to ensure that inflation does not become unhinged? Okay, and so therefore that led me to coming up with this topic along with my portfolio managers to look at the REITs sector. We know that it is down. Right? There's no denying that prices are down for Asia Japan REITs. But if we look closer at the fundamentals, are they out? Okay, are there any glimmers of hope that we can look forward to in 2023? What is the long-term outlook? Because we also believe that investing should be a long-term, and as Jared pointed out, we do want to educate investors as we look at this asset class, right? Other than just REITs, is an ETF also something that you can consider? I'll move on to my next screen. Jared, just give me a wave if my screen is being shared properly. Okay, it's all good. So the agenda, in a nutshell, is split into 4 sections. Share prices of Asia ex-Japan REITs are down. So I've got a slide. It's not a pretty slide, but it is what it is. Section 2, right, fundamentals, we think remain stable. We'll have some examples along the way to illustrate that, and then why we think that they're even improving for some sectors. Right. Section number 3, rising interest rates, right? That's really what central banks have been doing as they tackle inflation. It's a big concern for them. No doubt it's a headwind, but right, impact, is it limited? What is the actual impact? When we look down at the financial reports of the individual REITs that constitute this our ETF and the Asia Japan REIT sector as a whole. And then number 4, we'll just end it off. We take a look at the valuations, at historical trends, and because of that, we believe that valuations are now at attractive levels. And then if there's time, we can especially during the Q&A, we could look at its constituents of the index that the ETF tracks. Okay, so this is the chart of the Nikko AM Straits Trading Asia Japan ETF. So that's our ETF, Nikko AM's ETF right there. We're just using this as a proxy. So if I got a quick glimpse of Jared's screen just now, the chart looks very similar. Right. So as of today, I think market close, I saw that the REIT ETF is trading at 92 cents per share, and that's 30% down from a high of $1.32 as of July 2019. Unfortunately, that's also the time where I was also invested in it. So as I said, it's not a pretty picture, right? And there are headwinds. Are they still rising, right? But I think there are definitely headwinds there with interest rates. And then lastly, I think this is a situation we all want to avoid as central banks tighten, go into this whole quantitative tightening measures, this entire cycle. Is the possibility of a US recession going up? Is it going to increase? And does that translate into recessions into the Asia markets, Singapore, Hong Kong in particular? So that's the context. That's the backdrop that we are painting this evening, right? So it's definitely down, right? But now section 2, this is where we try to look for silver linings. So when we looked at it, fundamentals are stable and are improving for some sectors. Right, in bold here, this is instructions from my compliance. Reference to any particular securities or sectors are purely for illustrative purposes. Does not constitute any recommendation to buy, sell, or hold any securities, and should not be relied upon as financial advice in any way. Right, so this is a disclaimer. We are a Japanese company. we are a bit more conservative when it comes to these. So bear with me as we move on to the next slide. So we start with the Singapore office spectrum of things, right? We look at it first when we look at rentals and supply. So when we talk about Singapore office, obviously Grade A office space is what we look at for at the very beginning. So just for primer, for in terms of terminology, Grade A office space refers to modern, well-located buildings. Most of which, in general, are in Singapore Central Business District. Right. So if we look at the chart at the top here, you can see that Grade A office rentals rose. We're looking at Q3 numbers, right? 2.7% quarter on quarter. So from last quarter, Q2, it rose about 2.7%. And we look at year-to-date numbers, at the end of 2021 to today, well, as when this data was cut, it's up 7.4% year to date. And then Jones Lang LaSalle, they expect Singapore CBD Grade A office rentals to rise by about 10% to close of the year 2022, followed by a rise as well as 2023. Not as much as 2022, but about half of that, 5% in 2023. And you can see from the chart here, it has been depressed, no doubt about that. But you can see Q2, Q3 numbers have started to creep up. So we looked at demand. We also look at supply side factors, right? So new office supply, I think it will remain tight in 2022. This is really because of removal of effective supply from OCB buildings that have now been taken off the market, right? Such as the Fuji Xerox towers, right? I think that's really at the edge of the CBD near Tanjong Pagar, if I'm not wrong, and then the very iconic AXA towers, right? So that because they're up for redevelopment, that's actually constraining supply in the market when we look at Singapore office space. Despite that, there is new supply that is coming in, but not a lot. Okay, so we have got about 870 million square foot that is coming in that's new over the next 3 years in the central area, which is comparable to the historical supply over the 5 period back from 2021. Some of the new supply that's coming in, this is at the bottom of the screen here. You can see my mouse, right? I think the iconic one, the one that's gotten a lot of people's attention is my Central Boulevard Tower. I think it was in the news that Amazon had already committed to about 30% of the space that's going to come up in 2023. So all in all, there is new supply to sort of overcome, the tightening of supply because of the redevelopment of Fuji Xerox and AXA, but it's not much, and it's on trend. So we're not seeing a massive oversupply. So that keeps this space tight, which is why we think fundamentals are actually holding quite stable. Now we look at Singapore industrials, going back again to rentals and supply, and I think that the trends here are also showing some, positive green shoots here. So Singapore industrial rentals rose 4.7% year to date as of September 2022, after rising 2% year on year in 2021. So you can see all the 4 lines, multi-user factories, single-user factories, business parks, warehouses. If we look at the Singapore Industrial Rental Index, as we go into Q3 2022, you can see that there's a slight upwards trend, right? So if we look at occupancy rates, it's actually quite healthy. It's almost 90% in September 2022, right? Now we move to one of the biggest components underlying REITs in the sector that this ETF is tracking, right? Which is the CapitaLand and Ascendas REITs Singapore. So its properties rental reversion was up 4.4% year on year as of end Q3 2022. So rental reversion is really a metric used to capture whether the new leases that have been signed is higher or lower than the previous rental rates. So if it's positive, it just means that when you sign a new lease for that property, if rental reversion is up 4.4%, that means there is a positive of 4.4% in terms of the rentals that you can attract for the property. In terms of supply again, right, we have got in total about 4 million square meters that is going to come online in the next 4 years, up to 2026. So that's the number right here, if you can see my mouse. So the blue row here, 4 million, that's across the different sectors: business space and life sciences, industry and data centers, that's the biggest part, and logistics. So new supply coming in, 4 million. Is that a lot? In context, we don't think it is a lot, because it's only representing 8%, if we round it up, of existing supply. So new supply that's coming on in the next 4 years is 8% by 2026. So it's only about a 2% increase each year, right? That goes up to about 8% by 2026. And of that, 4 million square meters of existing of supply that's going to come online, there's actually further tightening of supply because 71% of that new supply has already been pre-committed as of March this year. So in terms, if you look at the supply and demand dynamic, right, it's what the picture we're painting here is that supply is tight, new supply is tight, and on top of that, it's already been pre-committed up to 70-80%. Now retail, I think retail was I thought about retail really because of the COVID reopening story in Singapore. So Orchard Road, I think we're all very familiar with that. Retail rents rose a little bit, okay, 0.9% year on year. Back in Q2, that means first half of 2022, and then 1.9% year on year in Q3, respectively. So that's the dark blue line you can see over here. Right, so 0.9 at first in Q2, Q3 there was a slight increase of about another 1%. So you can see that the trend is inching, just creeping higher. Right, still a positive. It's not. We shouldn't be celebrating. Yeah, but I think the trend is there, and that's for Orchard Road retail rents. Now we also look at suburban retail rents. So similar picture. In Q2, suburban retail rents rose 0.7% year on year. If we look at it, the data in Q3, that rose 1.4% year on year. But now we look at the yellow line, which is retail sales x motor sales. Right, we strip away motor sales because that would skew the picture too much. But you can see that retail sales has actually jumped up, has done a massive recovery from the lows suffered during the COVID crisis, which is Q2 2020. That's a short spike down there, and it recovered very well, went all the way up to almost hitting 40%, and then it's maintained. It's not come back down all the way. It's currently around 10 to 20% now. So there is some room for rental growth to catch up to the strength in Singapore retail sales growth. So according to JLL research again, so Singapore prime retail and suburban rents are expected to rise by an average of about 2.9% per year for the next 5 years. Once again, we look at the supply side again. So future retail supply in Singapore will continue to remain low for the next 5 years. So we're not looking at a lot of retail space being opened up. It's only going to be 0.6% per year for the next 5 years. That's really the next the red color section here, and forecast by JLL research. Still back on retail. So what we have seen is tenant sales has actually recovered beyond pre-COVID levels, right? Using pre-COVID levels as a benchmark, we look at tenant sales, how much tenants sales numbers are going up or down versus pre-COVID levels in 2019. And then we look at shopper traffic. So the good news is that in third quarter 2022 this year, tenant sales for suburban malls, and we're using Fraser Centrepoint Trust as an example here, have now recovered. It's now above pre-COVID levels. But if you look at the chart here on the top right hand corner, you see pre-COVID average, right? The blue line is still underneath that pre-COVID average. So I think one way we can look at it is that shopper traffic, there are less people going out into the malls, but in terms of spending, they are actually making up for that by spending more, so that tenant sales are actually above. So maybe there is more room for recovery, as if we think that shopper traffic could actually go beyond the pre-COVID-19 levels. So that's suburban malls. Now we use Suntec REIT as just an example, right? When we look at tenant sales. So that's the dark blue line here. Tenant sales for the whole mall and tenant sales for same stores. You can see that These two blue lines have also gone above the 2019 pre-COVID levels, and we see a same trend as well. Shopper traffic is kind of recovering. It's trending upwards marginally, but it's still below pre-COVID levels. So for both suburban malls as well as downtown malls, we see the same trend. Now, so it won't be Asia x Japan if we only focus on Singapore. So Hong Kong REITs do belong in the index that the ETF is tracking. So Hong Kong retail sales, I think this is really the the whole opening up of Hong Kong and China, from the restrictions and lockdowns that we've seen in China and Hong Kong, really that's been rolling for the last 2 years or so. So as social distancing measures relax, starting I think in late April this year, we are also seeing that Hong Kong retail sales are starting to make a comeback. Right, it's still very early days. You can see that right here in the last in the last quarter of this year, right? They're not out of the woods, but at least it's showing a slight upward trajectory. And Link REIT, this is the largest REIT really in Hong Kong. So its first half financial year end statements, it showed that DPU, so dividends per unit, rose 1.9% year on year. Tenant sales as well rose 3.8% year on year versus a lower number, 0.8% for the industry. And then food related tenants account for 67.2% of Link REIT's Hong Kong retail mix. So that's right here. And once again, we revisit rental reversion, right? So for Link REITs, the Hong Kong retail 8.5%, which is a good number, which is positive for the first half as of March 2020, ending March 2023. Okay, so that is a snapshot of Hong Kong retail sales using Link REIT as just an example here. So we've painted a picture across different sectors, office space, retail space, industrial space, Hong Kong, Singapore, right? And now we're looking at what we decided to do. We look at whether there's any positive rent reversion, right, based on the latest quarterly results, business updates on some of the REITs that the ETF and the index tracks. So what we have found is that when we looked at the latest reported data, it shows that the underlying fundamentals still remain stable, and most REITs reported positive year-on-year rent reversion for the portfolios that these REITs are managing. So this is, I think, really the most relevant, the largest REITs in the Asia ex-Japan space. So we've got CapitaLand and Ascendas REIT, year-on-year rental reversion is up 8%, positive 8%. Right, CapitaLand Integrated Commercial Trust, retail is up 0.6%, slightly less, but you can see office has gone up by about 7.9%. Fraser Centrepoint Trust, just the retail portion only, is up 4.2%. Embassy Office Parks REIT, 14%. Link REIT, we took a look at them earlier. So Hong Kong retail is up 8.5%. The Chinese retail properties is up 8.4%. Lastly, we'll just look at Maple Tree Pan Asia Commercial Trust, 1.1%, Vivocity 7.7%, Maple Tree Business City 3.8%. So these are all sourced as we try to piece the picture together from any company presentations as of last month in November. So dividends per unit, so DPU, is also something that we track just to see, just to help us paint a picture of the REIT market in Asia ex-Japan. So what we did here, we have got, I think, about 43 REITs in the basket that the FTSE EPRA Nareit Index tracks, right? And we extracted Bloomberg consensus forecasts And what we found is a surprisingly, well, it's an encouraging picture, because out of the 43 REITs in the basket that the index tracks, 33 out of them actually show positive DPU growth on a 3-year compounded annual growth rate basis. And let's just take a look here. Generally, I think you can see that other than a couple, 3 outliers here, which is Capital Land Escort Trust, CDL Hospitality Trust, Vice Hospitality Trust, everyone else at least showed positive DPU, positive DPU growth, right, of around 2 to 3% on average, maybe a bit lower, 1.5 to 2% on average. These are the Singapore REITs, right? I will move over to the Hong Kong REITs. This is the second largest portion of REITs. These are the Hong Kong listed REITs. So Fortune REIT, Link REIT, positive territory. Champion REIT and Yeshu in negative territory, and we unfortunately do not have data on Prosperity and Sunlight REIT. The rest of the REITs in the basket are made out of Malaysia, India, Philippines, and Korean REITs, and they are generally a more positive picture. I think one reason why the Hong Kong REITs, you can see it's slightly more negative. It's really, once again, back to the the lack of the reopening story that we see in Singapore and the rest of Asia. Okay, so but of the remaining 10, 5 are expected to register negative DPU growth. I think we saw those 5. The other 5, we do not have much data on that. So on a weighted average basis, right, the entire basket, the index, is expected to register a CAGR of 3.5% per year over the next 3 years. So that's what these two charts are trying to show. So after painting I would like to say a rosy picture, but it's not, I think, but at least it's early signs of hope about where we look at the fundamentals, right? I think the bugbear in the room is rising interest rates. So exactly how big is that impact? So no doubt, higher interest rates are a headwind for REITs, given the average gearing level of 35% of total assets. So, however, most REITs in the FTSE in the index, right, the FTSE Pranari Ajax Japan REIT Index, have a significant portion of the debts pegged to fixed rates at about 70.3%. So, when we looked at the composition of debt, their gearing ratios, their gearing levels, and we look at a theoretical 100 basis point hike in interest rates, the number that was churned out, we expected it to have a negative 2 to 3% impact on annual earnings and dividends per unit for this entire basket, reflected by the index. So that's really because if you look at the composition of debt, the pie chart right in the center here, right, 70.3% is actually pegged to fixed rates. The 29% or about 30% of it is pegged to variable, and that's the one that's most sensitive to any increases in interest rates. So the caveat here, of course, is that, and you may ask, right, these fixed rates are not going to be fixed forever. So it is true. I think that's on average, that would mean it's fixed for about 2 to 3 years, and then depending on the ability of the REITs for them to renegotiate and refinance those fixed rates, which would expire in about 2 to 3 years now. But as of today, any short-term or immediate impact by raising interest rates, every 100 basis points, we're only going to see a 2 to 3% impact on annual earnings or DPU. So yeah, I mentioned 2 factors that go into how much impact there would be for rising interest rates on DPU. So this The negative impact on dividends per unit for the major REITs, so that's these REITs that we picked out at the bottom, is estimated at between 1.5 to 3.3%, right? So for every 100 basis points. And the picture is about the same. Right? Previously, for the entire index, which is 43 different REITs, it's about 2 to 3%. For the major REITs, it's actually a bit lower, or the range is a bit wider, 1.5 to 3.3%. Right? So the two factors that really affect DPU impact is really the gearing and percentage of debt pegged to fixed rates. So let's take CapitaLand Ascendas REIT here. The gearing ratio is 37.3. It's slightly higher if you look at the averages at the handful that I've picked up here. But they do have about 78% of debt on fixed rates. So the change in DPU is 2.2. But if you look at Capital CICT, right, Capital Integrated Commercial Trust, the gearing is higher. You can see it's about 4% higher than CapitaLand Ascendas REIT. Their percentage of debt on fixed rates is also higher, but not much higher than, it's only 2% higher. But you can see the change in DPU goes up, and it's up to 2.6%. Now, I think most instructive, we go look at the last one here, Mapletree Peninsula Commercial Trust. Their gearing is at 40.1%, but their percentage of debt on fixed rates is more to the lower side, 72%, 72.5% on fixed rates. Therefore, you can see that the change in DPU, the impact is actually quite high, it's 3.3% relative to the rest that we've picked up here. So you can see that gearing really is a factor that you should consider, not just the gearing when we look at individual REITs. It's also something that you should consider, and not just look at the percentage of debt on fixed rates. Because even if you've got a high percentage of debt on fixed rate, for example, in the second example here, if your gearing is higher, the negative impact on the change in DPU would also be affected, would also be higher. So I think the last point I made in two previous slides away is we're saying that the debt is pegged to fixed rates at about 70.3, and that's expected to last maybe in a short medium term for at least 2 to 3 years. So when that happens, when they have to bite the bullet, right, because of high interest rates, assuming that interest rates remain elevated, and that's the reality that markets have to face, for the next 2, 3, 4 years, is there anything that can offset that increase in interest rates? I think it's in the REIT space. I think that is a possibility, because if there are high interest costs, what we're saying here is that revenue growth can offset high interest rates costs. Because if high interest rates are the consequence of an increase in inflationary pressure, and we're looking at, because there's good economic growth, labor market in the US is actually doing quite well, overheating of the market, etc., etc. REITs will also benefit from a pickup in rentals. So what our PMs have found and are suggesting is that net profit and dividends are actually more sensitive to top line or revenue growth than a rise in interest rate costs. So the estimate is that for every 1% rise in revenue can offset a 7.5% rise in interest rates. So if you recall earlier, a 1% rise in interest rates would result in a negative 2 to 3% on average rise in interest rate expense. But what we're saying here is that there's an outsize, there's a bigger impact. If your revenues can increase by 1%, you can now offset a bigger 7.5% increase in interest rates. And the example that we came up with, that we brought up here, is Mapletree Logistics Trust. So you can see that gross revenue, or 11.4% rise in gross revenue, can more than offset a 33% rise in borrowing costs. So resulting in actually a 16.1% increase in distributable income. So that's the story that we're trying to paint here. Now this is really section 4. I'm also conscious of time. So I've got, I think, only 3 more slides. So if we look at dividend yield and yield spreads, Singapore and Hong Kong REITs are still one of the highest dividend yields among the different geographical REIT markets. So this is just comparing Singapore and Hong Kong REITs versus other geographical REIT markets. You can see that Singapore REITs offer 6.9% yield thereabouts. Hong Kong REITs slightly higher, 7.5. In general, still higher than some of the other markets, barring Euro ex-UK REIT markets, which is actually quite high, 7.4%. Yield spreads as well are also relatively healthy. So this is really the difference between the gross dividend yield on the REITs that you're getting versus the risk-free rate of the country where the REIT is located. So in terms of yield spreads, there's still significant buffer, about 3.5 and 3.4 for Singapore and Hong Kong REITs respectively. So once again, only really losing out to the European or ex-UK REIT market. So when we say that the yield spread, when we look at the historical trend, dividend yields for Singapore and Hong Kong REITs are now above historical averages. So the yield spreads for Singapore are close to historical averages. So that's really the give me one moment. The black line here. And in terms of yield spreads, that's the red line here. It's close to historical levels. Hong Kong REITs, you can see that dividend yields have actually exceeded historical levels, and yield spreads are also now, for the Hong Kong REITs, also above historical levels. I believe this is my last slide. We look at the NAV, net asset value, whether it's at a premium or discount, and we look at the trends. So current valuations based on price to NAV for both Singapore REITs and Hong Kong REITs are now at attractive levels as they are actually trading at discounts to NAV. So why is that? Why is that something that we take note of? Because the NAV or net asset value premium discount, it's really a percentage that calculates whether a REIT is trading above or below its net asset value. So if it's trading below, that means you're getting something at a discount, right? If you go shopping, it's always better to get things at a discount. So this metric is always something that we will look at because it's valuable for us to get a pulse of whether the REIT market or the particular REIT is trading far or near to its book value or net asset value. So because now you can see that versus historical trends, if you pull data back all the way for 20 years, you can see that at this point of time, it does represent, from a historical perspective, a pretty decent discount, and that is why we think valuations are attractive at this particular point of time. Okay, it is 7:46. I know that's really the end of my prescribed time. I think we can open up for questions.
Yep, thank you, Eugene, for this very, I would say, insightful, full of information deck and presentation. We do have, I would say, a few questions from the audience, in which some, I think, towards the later part, you have addressed, particularly on the rising interest rates, how will it affect the REIT market? With other than that, we do have one, I would say, a more relevant question as to what's happening in the markets today. So it's really on the topic of inflation, right? This is what it has been all about for the past 2022. So inflation has clearly been a concern, or I would say a fear this year. So is this particular REIT that you have, Asia X Japan REIT, would this be an effective hedge against inflation?
I think that's that's a very good question, right? How do we hedge against inflation? Because I think as an investor myself, or even just living in this day and age, inflation has started to bite us in many different ways, right? So I think the question is Asia ex Japan REITs, and I'm talking about the whole basket, can it be used as an effective inflation hedge? I think that there is underlying reasons why we think that is possible. Really is because the underlying leases of Asia ex Japan REITs are generally shorter than those in developed markets, as we saw like Europe, US, etc., etc. So this is good because as inflation takes hold through higher prices of goods, because the leases are short, it means that landlords can now, as the leases end, landlords can now raise rents to keep up with inflation, right? As the leases are renewed. So in this way, this asset class, specifically Ajax Japan REITs, can can better align itself as inflation continues. Because once again, the reset is faster, right? So as inflation rises, you can catch up. Whereas what we see for developed markets, you're stuck, right? And you're stuck
Mm,
in a bad situation. You can't reset as fast as Asia, Japan REITs in general. Yeah,
yeah,
and then what's also good is that I think with inflation, there's always the fear of recession, right? I think I think especially in Asia right now, because of the pain that Asian markets actually has gone through, I think let's say for the Asian financial crisis, for example, markets are just central banks in Asia are just better prepared for any kinds of recession risk. So the assets of the Asia Japan REITs that we looked at are often they're located in places with stronger GDP growth, economic growth prospects, etc. into at least the medium to long term, right? So therefore, in that way, there is always some kind of buffer because of really the strong economic growth prospects, stronger GDP growth expectations in the markets that these REITs are operating in. So
definitely.
I hope I answered. I know I talked about inflation first, but also I think on my mind at least, recession was also a big issue in my mind. So I hope I gave some additional color there.
Definitely. Thanks for this wonderful knowledge and sharing. I think we are coming towards the end of this webinar. It's 7:50, slightly over time. Apologies. So, if you have missed out or if you like to look back at what Eugene has mentioned earlier, we always have recorded versions of our live webinars, which will appear either in our webpage or within the platform itself. So there's a QR code which you can see on the screen right now, I believe. You can scan the QR code to access this webinar. And of course, you know what to do, where to look for this Nico AM REITs available within our platform, which you can access 24/7. With that, I would say let's end off this webinar. Once again, really thank you, Eugene, for this wonderful sharing. I myself, I have learned a lot from this, and perhaps I can take a look at the REITs market again.
Right. Thank you, Jared. Thank you, everyone. Yes, I know that it might be a bit heavy, um, but there's a lot of resources on our website nicoyam.com.sg. Um, that's where you can reach out to us at any time as well if you have any further questions on our ETF that you'd like to find out more. Otherwise, thank you so much again, and have a good evening, everyone.
Thanks for joining, everyone. Have a good one.